Hi, today I'm going to talk about a group of companies I like to call boring compounders. These are stocks which are not hyped up, they are not so well known, and they are quite boring. They are not out there to change the world. However, despite this, they are silently compounding in the background and often do 100x without many people noticing it. In this video, first I'm going to demonstrate 3 of these mature boring compounder companies. Then I'm going to try to find commonalities between them to help us recognize if we found one of these boring compounder companies. And finally, we will going to take a look at a few examples which might be a younger version of these boring compounder company. Okay, so the first example of these boring compounders is this Old Dominion freight line stock. So it is a freight transportation, less than truckload transportation company in the United States. And if we check the actual growth rate of this company, we can see that it did 100x. So right now it's about $360. And it did 100x, let's say, since 2003, giving it a growth rate of about 25%. Since the dot-com crash, it was a 31% annual growth. With this growth rate, it easily beat out much more famous stocks, for example, Amazon. So it is widely known that after the dot-com crash, the Amazon crashed to very, very low price, I believe about $2. And since then, it has returned a very impressive 30% annual return. But this is still less than our boring compounder company, which at the same time returned about 31% annually. So the next example we are going to analyze is Tractor Supply Company. It is a rural lifestyle retailer. It operates several retail locations in the United States. And if we again look at the growth of this company, it is right now about $230, which means that it did 100x since 2001. And if we actually check the growth rate, it's growing in the 20% annualized returns, sometimes even more in the 30%. And with this growth rate, it easily beat out other companies like Microsoft. So if we check the Microsoft return over the same time frame, we can see that it's about only 13-14%. Our last topic we are going to analyze is this Pool Corporation. So what they are doing is distributing swimming pool supplies, equipment, and other leisure products in the United States. So again, if we check the growth, we can see that right now it's about $400, which means it did 100x since about 1999. This gives it an annualized growth rate on the 20% range. So we can see, for example, since 2008, it has returned an annualized 26% annually, beating out stocks like Google here. So the Google in the same period since 2008 has returned roughly 18% annually. So as you can see, these boring compounders often have a much higher return than the market. They can beat very hyped up stocks as well as companies that are actually changing the world. So if we could somehow find these stocks early on, let's say 5 to 10 years in their growth, then we could invest in them and get a very high return. But how we could actually spot these stocks is the difficult part, and I believe I have collected some commonalities between these stocks, which I have detailed in this slide. So first of all, a boring compounder have to be good at compounding. So every company is aiming at least to be a compounder, but not every company can do a good compounding. So for a company to be a good compounder, it has to be profitable. So obviously a company that is not profitable is not able to reinvest that much money, or reinvesting only in debt, which is not a sustainable strategy in the long term. So we can check these example stocks, and if we scroll down to the EPS, for example, and check it, as you can see, this company has been profitable since at least 1997 continuously. Our next example, Tractor Supply Company. Again, we can see the same here in the EPS. That it is profitable since a very long time. And finally, the Pool Corporation. Again, we can check the EPS, and we see the same thing, that it is profitable since 1996 at least. Meaning that the company will have and does have money to reinvest. Next up, high return on invested capital. So a lot of companies are profitable, but that doesn't mean that they are good compounders. To be a good compounder, you need to invest money in a way to cause high return on that money. So if we check the return on invested capital, we can see, for example, the old Dominion Freight Line, that it had a continuously high return on invested capital, about 30%, sometimes even 40%. We can see same on the Tractor Supply Company. It had a little bit lower return, but since about 2003, it has about 40% return on invested capital. And finally, for the Pool Company, again, we can see that the return on invested capital is about 20, but often in the 30s. Next up, high reinvestment. So it means nothing that the company has high return on invested capital and profitable if the company doesn't actually reinvest the money. HP is a good example for that. So HP is a profitable company, yet it hasn't grown their revenue since about 2002. It seems like they have spinned off something here, but even considering that, they don't actually grow that much. So even though they are profitable and they have a high return on invested capital, as you can see, about 20, 30, 40%, but the trick is that they are not really reinvesting a lot of this money, but they are actually going to share buyback. So if we check the share buyback per net income, we can see that about 50, 60, sometimes 150% of the net income is actually going into buying back shares. Plus, they also have a dividend, so they have this high payout ratio as well, so 30-20%. Adding all of these together means that almost all of the money which they earn is flowing back straight to the investors instead of reinvested back into the business. So it cannot compound because the company is not actually investing all of that money. So reinvestment could be done in two main ways. So one of the ways is the capital expenditure. They are buying equipment, they are investing into new locations. And the second one is acquisition. So they are buying up other companies. The best kind of acquisitions, in my opinion, are those that the company is actually buying up their own competitors. So if we check these companies, then for example, Old Dominion Freight Line, if we search for the acquisitions, then they did some acquisitions, though in this case, they, instead of doing the acquisitions, they just invested more into the business as a form of capital expenditure. So if we search for CapEx, they are investing about 20% of their revenue back into the business. So I assume mostly to have all of these equipment available, tractors, trailers, distribution centers, and so on. Again, we can check the Tractor Supply Company. So the Tractor Supply Company is also owning a bunch of other brands. Many of these brands are got to them through acquisitions. And again, the Pool Supply Company, we can see that it has acquired many companies over the years, like Superior Pool Products, Fort Wayne Pools, and so on, which were potential competitors for this company, and by buying up these companies, the pool supply company was able to increase their revenue, possibly increase their net margins because they have now less competitors. Next up, we also want a good balance sheet for this company. If the compounding happens from a lot of debt, that could be an issue down the line. For example, if the interest rate is increasing. We can value the balance sheet in multiple different ways. I prefer using the Altman Z-score for that, but other ways exist as well. For example, checking the long-term liabilities divided by the cash flow to see how many years it would take to pay off their debt. Also, it might be worth to check the assets divided by the liabilities, see whether there are more assets than liabilities, as well as the interest coverage ratio. Again, we can check it here by searching for the Altman Z, and we can see that this company has been in a fairly high value, so about 2.6, which is not ultra high, but it's fairly stable, sometimes even at around 5. So good balance sheet here. Next up, Tractor Supply Company. We can search for the same, and we can see this has been about 4, which is a fairly strong balance sheet. Next up, Pool Supply Company. We can check, and again we can see that about 4 to 6, so very stable balance sheet. And finally, the low standard deviation of the growth. This is just an observation of mine that all of these companies basically share. So what this means is that the growth is fairly consistent. What this means is that there is a constant demand of what this company is selling. As you can see, if we look at the EPS, especially on the logarithmic curve, it's almost a perfect growth curve. Sometimes just there are these humps as a result of recessions, but other than that, it's almost a perfect growth curve. And the way to see the low standard deviation is to check the growth rate. So bar height is fairly consistent, which means that the standard deviation is fairly low. Overall, again, there are these recessions here, but ignoring those, it is a fairly low standard deviation business. They don't go negative for a period of time, then skyrocket, then go negative like some other companies. There are constant demand for these companies. Next up, we might have found a good compounder companies if all of these are matching. However, next up, we want to make sure that our share of this company is actually compounding. So if the company is diluting us while it is compounding, we may not actually have a compounding company. So we want no or minimal dilution, as well as minimal stock-based compensation. So preferably a company, instead of diluting, should buy back shares, but not too much, because that could eat into their reinvestment and decrease the amount of reinvestment it can do into itself. I would say that probably less than 1% dilution is still acceptable. A lot of companies do dilute early on and later on start to buy back shares. So we can check, for example, the old Dominion Freight Line. If we search for share count, we can see that early on there were some increase in share count as a result of acquisition. Sometimes these larger jumps here, but since let's say about 2011, it has continuously bought back shares. Next up, Tractor Supply Company. Again, we can see the same thing. So it has increased the share count till about 2007, then it started to decrease it. Next up, Pool Corporation. So again, there was some increase in share count here, and then since 1999, it has started to buy back shares. And next up, we have these stock-based compensation. So the stock-based compensation is also diluting the shareholders, but it happens at a later date, when the employee is actually exercising their stock-based options. So for this, I have these stars, so stock-based compensation per revenue and per market cap. And as you can see, this company has only recently started the stock-based compensation. Next up, Tractor Supply Company. Again, a lot of again, for most of the time it didn't do stock-based compensation, and even when it does, it only about 0.2% of the market cap, which I consider okay. I generally like it below 1%. The Pool Corporation, again, we can check that it didn't do stock-based compensation, and starting from about 2009 it did some, but it again less than 1% of the market cap. And the last point is that we want a boring company because we are looking for boring compounders. That's not to say that you can't make a lot of money with companies that are actually changing the world. However, for this category, we want boring companies. So boring companies have some advantages. Changing the world is expensive, it is risky, and chances are that companies which want to change the world are already hyped up, which means the stock price is already pretty expensive before you even start to buy your first share. Again, Old Dominion Freight Line is just a freight line, Tractor Supply Company is just a retail chain, and the Pool Corporation is a distributor for pool-related products. So pretty boring business models, not something that actually wants to change the world. So next up, let's look at a couple of examples of a young, boring compounder company. What we have looked before are very old companies already, so 20-25 years. They have been compounding continuously, and indeed those who have invested in the early phases, for example in this Old Dominion Freight Line stock, have been very nicely rewarded, as you can see in the 30s or 20s. As the company gets bigger and bigger, it also getting included into indices, and also people start to notice them more. So the PE ratio will also grow up. As you can see right here in the 2000s, after the dot-com crash, it has only about 5 P ratio, but it has been continuously going up and up. So now the P ratio of this company is around 30, which means our expected return in the long term will be lower. But we can use these criteria to hopefully find compounders which are much younger, have much more to grow, and much less noticed by other investors. Now, of course, I can't guarantee that they will 100x or 10x or they will be a compounder. This is something that remains to be seen. However, it's a good sign that they look like the previous mature boring compounders. So the first example of these boring compounders is Malibu Boats, MBUU. This is a fairly small company, so if we search for market cap, it's only about $1.2 billion market cap now, so pretty young and small company. It has been around since about 2014, or at least it has been public since 2014, and we can check whether it fits all of our criteria. So first of all, is it profitable? So looking at the EPS, as you can see, it has been profitable and it's continuously growing. Next up, does it have a high return on invested capital? So if we search for return on invested capital, so we can see that it's between the high 20s to about 40%. So right now, based on their last report, it was about 40% return on invested capital. Next up, does it have high reinvestment? So we can check their payout ratio. As you can see, they are paying out a very small amount of money, as well as they have very low buybacks, so only about 22% of their net income. Going to their Wikipedia page, you can see that it's growing employee count, US and in worldwide. They are buying companies, they are buying other companies, and overall going to their investment page, this was their original brand, and they have continued to buy up more and more companies. So these are possible competitors to their original brand, and now they are getting revenue for these possible competitors. And all of this means that they can increase their net margins as they have less competitors now. As you can see, there is a general upward trend here. Next up, does it have good balance sheet? So we can search for example, the Altman Z score to check. And as you can see, right now it's about 6, which is a very good score here. And if we search for their interest coverage, as you can see right now, they have about 77x interest coverage, which is again very, very good. Checking their assets here, as you can see, the assets are growing while the liabilities are actually falling. So again, a good balance sheet here. And finally, low standard deviation in the growth. Again, we can look at just the growth curve. It is basically a continuous growth here, as well as the EPS, which again is continuously growing, or we can find the actual bar chart down here, and as you can see, very low standard deviation. It is basically continuously growing at a fairly high rate of about 20-30%. Next up are the shares compounding. So we can check for the share count here. And as you can see, there has been some dilution here, almost doubling the number of shares. However, since about, let's say, 2018, it has been going downward. And hopefully this trend continues in the future. And we can check for the compensation. So the share-based compensation is only about 0.4% of the revenue and 0.8% of the market cap. So very low stock-based compensation here. So this is a check again. And finally, is it a boring company? Well, they are doing nothing but making and selling boats. So a pretty simple business model, not here to change the entire world. And also if we check their P ratio, as you can see, the P ratio is 7. Despite the long-term growth rate about 25%. So is it a boring company? I would say yes. They have a simple business model, a simple boring business models, and investors are not noticing it much. So next example, installed building products, IBP. What they do is install installations, waterproofing, and many other products. So again, a fairly boring business model, not trying to change the world here. And let's check our list here. So have they been profitable? Again, we can check the EPS here. They have been continuously profitable, and their profit per share has been continuously going up and skyrocketing. Do they have a high return on invested capital? So if we search for it, we can see that their return on invested capital is again between 30 and 40. Right now, their return on invested capital is almost 40%. Next up, do they reinvest in themselves? So what this company does is using a lot of strategic acquisitions to grow. And as you can see, I searched on their investor relation page all the acquisitions. They had an acquisition in April, they had an acquisition in December, in 2021 September, in May, and so on. So they have about 10 pages of acquisition related news on their website. So they are very heavily buying up possible competitors, as well as just other companies in related fields. And all of these acquisitions are really showing up in their revenue and in their EPS. Next up, do they have a good balance sheet? So again, we can search for Altman Z score to check, and they have an Altman Z score of about 4.4, so pretty good. They have an interest rate coverage about 14, which is okay, not exceptionally well. and checking their assets versus liabilities. As you can see, both are growing approximately in unisons. However, the assets are growing slightly bit faster than their liabilities. Next up, low standard deviation on the growth. So we can search for growth. As you can see, extremely low standard deviation. Even if we look at a different interval, it is growing fairly consistently. Next up, are our shares compounding as well, besides just the company? So again, we can search for the share count to check. And as you can see, they have a slight dilution. However, since 2014, they have been continuously buying back shares. And their compensation per market cap is also staying below 1%. Next up, is it a boring company? And here I would again say yes. So it's not trying to change the world. It is doing important necessities which people do need. And if we search for the PE ratio for this company, and as you can see, it's only about 14 right now. So again, fairly low considering their growth rate. The growth rate, by the way, is about 37% annually. This was not a full analysis of these two companies, just looking at two possible boring compounders. Okay, and as a disclaimer, just because a company looks like one of these 100x companies which we have looked before, doesn't mean that that company will also 100x or that you will even make money. So it's investment, you will always have risk, and market conditions can change, especially when we are looking at small cap companies like this Malibu boat company. So thank you for watching and bye for now.